What happens though if you do not know which stock to buy? Or perhaps there are so many that you'd like to own that you just don't know where to start. Hello and welcome to Moneywise. We help you to make sense of the world of personal finance and investing. We'll start with the absolute basics in this first episode, with the different types of asset classes and how they work. First up is cash. That's right, cash, which may be a surprise to some of you. But what you have to understand is that cash is also an asset class, and in itself, a form of investment. If you choose to hold a large amount of cash, then that means you are invested in cash, because you believe cash can give you a meaningful return. But does cash really generate a decent return for you? Interest rates are extremely low at the moment, and hence the returns on cash are just as low. And that means that due to inflation, cash loses its value over time. Hence, it would be wise for investors to convert cash into some other type of asset class that appreciates in value over time instead. The stock market, for instance, is able to do better than what cash is able to return. And so do most other types of sound investments outside of cash. Let's now take a look at stocks, also known as equities. When you buy a stock, you own a portion of the company. Ownership of a company's stock comes with certain entitlements, which we'll cover in the next episode. I'll give you a quick rundown as to why prices move on the stock market. And it all comes down to two forces, demand and supply. When either one of these two forces is stronger than the other, prices move. For example, when there is a large amount of buyers looking to buy a stock from a small pool of sellers, buyers have to bid the price up in order to convince the sellers to sell the stock. The opposite holds true. When there is a large amount of sellers looking to sell a stock to a small pool of buyers, sellers have to lower their asking prices in order to convince the buyers to buy the stock. This means that anything that affects demand or supply makes the price move. Next up, we have bonds, also known as fixed income. A bond is essentially a loan. When you choose to buy a bond, you become a lender. The bond issuer who sold you the bond is the borrower. The terms of the bond are set by the borrower and made known to prospective investors like you beforehand, so that you can decide if you wish to invest in that bond offering or not. Bonds are used by companies and sovereign governments to finance things like development, operations, or maybe a specific project that they are raising funds for. Moving on, we have real estate. When people hear the term real estate, they think of housing. However, there are other types of property available too. Housing is also known as residential real estate, and these spaces are zoned for use as living spaces. And then we have commercial real estate, and these properties are zoned for use as workspaces like an office, or maybe for business activities such as a retail storefront or an F&B establishment, for example. And lastly, we have industrial real estate, and these spaces are zoned for use as warehouses, factories, or manufacturing companies that use various types of machinery. So what if you did not wish to fork out such a large amount of money to own physical real estate directly, but still wish to receive rental returns and get exposure to real estate? Well, you can, with something called a Real Estate Investment Trust, or REIT for short. A REIT is a company that owns, manages, and finances a portfolio of properties which generates rental. REITs trade on the stock market just like stocks, so they are readily available for you to invest in. So imagine every quarter you receive money into your bank account, and you can say that you're a part owner of a portfolio of properties, and these could be a variety of properties. In the digital age, you could even earn from properties that run and operate data centers. What happens though if you do not know which stock to buy? Or perhaps there are so many that you'd like to own that you just don't know where to start? Well, you can, with something called an exchange traded fund, or ETF for short. An ETF tracks multiple assets in a single basket, and this one basket trades on the stock market just like stocks. And that means this one investment allows you to get exposure across a range of stocks, bonds, or REITs that your chosen ETF tracks. So for example, if you like dividend stocks, you can invest into an ETF that tracks the best dividend stocks and earn dividends from those stocks. So going for an ETF is a safer way for beginner investors to get started and give your portfolio exposure to the best performers on the market. To wrap up, we now understand what stocks, bonds, REITs, real estate, and ETFs are. Join us again in the next episode where we will introduce you to the types of returns that these asset classes can give you and how they work. Thank you for watching. Please remember to like, share and subscribe. And if you have any topics or questions about personal finance and investing, do drop them in the comments below. See you!